Henry Hub's about $4 per MMBTU, a little over four today, and European gas is over $13 per MMBTU. And when I put on my thinking cap and think back over my career, you know, pre-shale gas revolution in the U.S., natural gas was quite high. I don't. It wasn't this high on a sustained basis in the U.S., but the whole thinking was, well, gas was almost like too premium of a fuel to burn in power plants. The thinking was that U.S. was going to be a LNG importer, have much higher gas costs, and the expectation was that coal was going to sort of reign supreme for some time in the U.S., given this higher gas price expectation a couple of decades ago. So I'm curious, with gas at relatively premium pricing, at least compared with the U.S., what's been happening within the power sector? Is gas use in the power sector increasing? Is it poised to increase? Can Europe do it all with renewables?
Gas-fired power will rebound to a certain extent in Europe, and that's because we will keep phasing out coal-fired plants. And like I explained in the beginning, because heating demand has increased, and that's weather-driven, and we don't have battery storage at scale or any other form of co-located system that could store renewable energy and fix the intermittency issues there. Yeah, I think gas demand for power, if anything, could increase this year versus last.
I mean, I think every time I'm in this call, I kind of have to explain the hurdles that these developers have faced because they keep recurring. And these peers have seen higher capital costs, higher development expenses over the last 2 to 3 years, just as they were ramping up their wind and solar additions, and that really constrained the leverage profile of these companies.
In the U.S. last year, they installed 50 gigawatts of new solar across the whole country. That represents a 20% increase over a year ago. That's the second year in a row of record installations. But you have to see where this is kind of coming from. Residential installations fell 30%. So that's kind of where you saw a lot of guidance cuts on the resi manufacturers, whether they're module manufacturers or inverter makers. But the utility side, they actually saw the inverse, a 33% gain in these installations. And that also represented another record.
Good morning, good afternoon, everyone. This is Rob Barnett, and I would like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. On the call today, we've got Patricio Alvarez joining from London today, normally in Madrid, but looks like he's also in close proximity to our two other guests, which are Joao Martins, also in London, and Alessio Mastrandrea in London as well. And we've got a few fun topics lined up for today based on recent earnings, some developments in the market, and some cool research from the team. So, Patricio, I want to start with you. I'm just looking at the screen right now. TTF gas looks like it's about 40 euros a megawatt hour. And you had a really interesting note out yesterday. Title of that note being Russia-Ukraine truce, China slowdown, risk sub 30 euro gas prices. So tell us about your outlook for gas here at the moment. How are you reading the tea leaves? What's the rest of the year going to look like?
Sure. So I think the point of the note is to try and sort of separate the headline risk tied to a potential truce between Russia and Ukraine, which I think is pretty obvious to the market. Any sort of peace agreement that entails a return of some of Russia's gas flows into Europe, which are at the moment fairly marginal. We're only flowing roughly 15 billion cubic meters a year right now from Russia, which is roughly 5% of European gas demand. So obviously there's three scenarios that we looked at. One is the status quo extends. And in such scenario, we do see a tightening gas balance during the summer because we do have a wider storage gap, and that's mainly because the heating season this past winter has been, there was stronger demand for gas in this heating season versus last, which would mean that we would probably compete for LNG with Asia again, and that's where the Chinese demand story comes into play. And Chinese demand has faltered pretty steeply since in January and February versus last year. LNG imports in China have declined almost 18%. So even if the status quo extends, we do see a risk for gas prices to at least be lower than our initial range of 44 to 50 euros per megawatt hour. The second scenario that we looked into was a potential return of Russian flows via Ukraine, which would add another 15 BCM, meaning that the supply pool would widen by 5%. That we think also again would pressure gas prices to the downside. And finally, what we think is it's a very distant possibility is the start of Nord Stream 2. It's something that has been talked about, I think, throughout the media and different industry reports. A return of, or let's say the start of Nord Stream 2, it's a pipeline that never actually got commissioned. There's only one section of the pipeline that wasn't damaged in 2022. If you recall, during those times, Nord Stream 1 was sabotaged. It's still, to this day, no one knows who was responsible for that. And only the second section of Nord Stream 2 is idle and unscathed by the sabotage. So a return to the market of this pipeline that I think would widen the supply pool quite materially, because that's 27 billion cubic meters per year. That's the capacity of Nord Stream 2. And why do we think it's very unlikely that Nord Stream 2 would come online? First of all, political opposition in Europe would be very, very strong against this. And the other one is that despite US policy on energy being highly uncertain at the moment, we think a restart of Nord Stream 2 would go against LNG commercial interests. So just for size, European gas demand has come off about 20% since 2021. That's mainly because of the Russian curtailment of gas. But all of the, let's say, all of the offset in terms of supply has mainly come from US LNG. So there's where we find, a very low probability of that happening. But if so, we think risks to gas prices, wherever you look, are turning to the downside, at least versus our previous scenario of about 47 euros per megawatt hour.
Patricio, you were mostly talking about supply there. Give me a sense of what's been going on with the demand picture in Europe. I know it's always struck me as quite surprising how much demand destruction there's been following both the pandemic and then the gas crisis that kicked off with Russia's invasion of Ukraine. But tell me, where do we stand here at the moment?
So we've seen a recovery in demand in the past, in the first 2 months of this year. Heating demand in February actually rose almost 20% year over year. And that's mainly weather driven. It's not really structural, we think. As I mentioned before, roughly since 2021, demand in Europe has come down roughly 20%, between 18 and 20%. And we think that mainly because of weather effects, 2025 will see a recovery of about 2%. So we would still be, sub 17, sub 18 percent what gas demand was in 2021, and that's mainly because of weather, and also because industrial demand continues to be very depressed, and elevated power prices, particularly in Germany, have hampered their industrial output there. And I think that's what made German elections in February quite interesting, because I think the only sort of convergence in the electoral platforms that we found is that Germany really wants to push down those costs for energy. So hopefully we will see some sort of policy incentives there that actually work and stimulate demand. But yeah, so far we think gas demand in Europe probably peaked in the mid 2000s, really. And we don't see a really bright outlook for it in the long term.
Well, it is relatively expensive. When I do my math here, I always have to check to make sure I'm doing it right. But Henry Hub's about $4 per MMBTU, a little over four today, and European gas is over $13 per MMBTU. And when I put on my thinking cap and think back over my career, pre-shale gas revolution in the U.S., natural gas was quite high. It wasn't this high on a sustained basis in the U.S., but the whole thinking was, well, gas was almost like too premium of a fuel to burn in power plants. The thinking was that U.S. was going to be a LNG importer, have much higher gas costs, and the expectation was that coal was going to sort of reign supreme for some time in the U.S., given this higher gas price expectation a couple of decades ago. So I'm curious, with gas at relatively premium pricing, at least compared with the U.S., what's been happening within the power sector? Is gas use in the power sector increasing? Is it poised to increase? Can Europe do it all with renewables? What's happened with other base loady types of power gen?
Sure. So I would say the short answer is that gas-fired power will rebound to a certain extent in Europe, and that's because we will keep phasing out coal-fired plants. And like I explained in the beginning, because heating demand has increased, and that's weather driven, and we don't have battery storage at scale or any other form of co-located system that could store renewable energy and fix the intermittency issues there. Yeah, I think gas demand for power, if anything, could increase this year versus last. But again, it won't be a massive increase. We still think it will sort of flow into that 1 to 2% overall demand recovery, and that's mainly to offset the curtailment of coal-fired capacity. In terms of renewables, we think they will keep growing. There's still capacity being added. Most of that capacity is wind and solar in Europe, but unless we fix the baseload issue, as you mentioned, which is exacerbated by the continued phase out of nuclear plants as well here in Europe, we don't see any other sort of clear options to offset that lack of stable baseload demand from coal or nuclear, really.
Okay, thanks, Patricio. So for anyone listening, feel free to drop a question into the chat. We'll try to work it into the conversation. I think that's a good segue, though, to bring on Joao. So Joao, you've got a note out this morning looking at the European situation for renewable developers. And I'm curious if you can share some of the findings from your analysis, and how does what you're thinking square with what we just heard from Patricio?
Yeah, sure. So as Patricio was saying, I mean, we do see renewables continuing to play a role, but our note kind of flags a period of slower growth over the next 2 to 3 years. And I mean, I think every time I'm in this call, I kind of have to explain the hurdles that these developers have faced because they keep recurring. And these peers have seen higher capital costs, higher development expenses over the last 2 to 3 years, just as they were ramping up their wind and solar additions, and that really constrained the leverage profile of these companies. So what we've been seeing since 2024, since the beginning of 2024, is some of the peers cutting their growth plans, and that has been very clear over the last earnings season, the 4Q earnings season, where nearly all of our peers cut their investment plans again. Some of them quite meaningfully. For example, EDPR plans a 40% investment cut for the next 2 years. As I said, that responds to leverage constraints. The peer group, on aggregate, their leverage reached about 3.6 times last year. That's versus 2x 3 years ago. So a really rapid ramp up. On top of that, there's mounting policy risk in the US that we also flag, not just from tariffs, but also from potential changes of the IRA, however unlikely that they are. That's a risk for these developers. And so we've seen most peers cutting their additions plan for 25 to 2027. What does that mean for earnings? We think, well, there's an obvious rebound in 2025 that these peers will face. That's because they booked a lot of impairments last year, particularly in the US, project impairments, because the return profiles shifted so much. And so there's an immediate rebound to be had this year. They also reached, in fact, record capacity additions last year, and the volumes of those assets will largely contribute from 2025. So 2025 might be a good year for net profit growth, but we think that's going to decelerate after to about 5% a year versus 15% this year. And that's, as I said, due to lower capacity gains and also still declining power prices in Europe, because as hedges roll over, even if spot prices recently recovered, the realized prices of these peers are kind of waning. So lower growth over the next 2 years. We think longer term, there is still support, as you mentioned at the beginning of the call, from tech and other corporates having an interest in contracting new renewable projects, because and again, as Patricio said, that's still the fastest technology to build. In Europe, unlike the US, as you said, gas prices in Europe are 3 to 5 times higher versus the US. So that means that gas is also a very expensive source of power. And so renewables continues to have a role in the longer term.
Yeah, I want to noodle a little bit on that, Joao. So when I look at your note, you've got a number of companies that I think folks will recognize: EDPR, Ørsted, et cetera. And you talk about this idea of a rebound in EPS, and I'm curious to get a sense from you, like philosophically, what. And you don't have to be company specific here, but what are the traits or factors that have led to companies performing better? Is it better located renewables, long-term contracts, PPAs? Are they better positioned to take advantage of that gas price differential you mentioned? What are the things that really matter to help shape a company with a better earnings profile?
Yeah, so for earnings, and I think if we look at the last 2 to 3 years, the two key factors have been one, geographical exposure, and second, the contracted portion of your assets. And until now, actually, companies that were exposed to the US were seeing faster growth because the policy was very supportive. I mean, it still is with risks though, but policy has been very supportive. Growth has been faster there. And so companies exposed to the US versus Europe benefited quite a lot. Also because in Europe, power prices declined. So even if you have a high share of contracted assets, you're still catching some of that downside. But as I said, secondly, companies that had a higher share of contracted assets, for example, EDPR did have about 70 to 80% of their assets long-term contracted versus Acciona, which domestically had a much larger share of merchant power, so exposed to spot power prices. The earnings profile of Acciona, for example, was much more volatile. So I think if we're just speaking about the quality of earnings over a 3 to 4 year period, the key factor would be the contracting portion of your assets.
Okay, thank you. This is probably a good moment to bring on Alessio. Let's go a little bit further down the supply chain. And I think when I generally look at the renewable space, it tends to be, it's been a very mixed bag so far this year. We've had some great results, strong guidance from some players, and then quite the opposite from some folks in the industry. And so, what do you think is driving that outcome that we're seeing, where we're getting great news from some folks in the solar wind space and not so great news from others? You know, how do you read this sort of confusing set of signals there in the marketplace?
Yeah, thanks, Rob. So I guess I'd like to nod to the SCIA report that came out this morning, or maybe it was last night. It kind of depends on where you're looking at in the supply chain and which geographies you're really looking at. In the US last year, they installed 50 gigawatts of new solar across the whole country. That represents a 20% increase over a year ago. That's the second year in a row of record installations. But you have to see where this is kind of coming from. Residential installations fell 30%, so that's kind of where you saw a lot of guidance cuts on the resi manufacturers, whether they're module manufacturers or inverter makers. But the utility side, they actually saw the inverse, a 33% gain in these installations, and that also represented another record. So that's about 41 gigawatts. So 80% of all solar installations in the US last year were utility scale. A lot of that being in Texas. And my favorite fact from that report is that domestic manufacturing in the US grew by nearly 200%. That's just a testament to the Inflation Reduction Act. And like Joao was saying, while there is some uncertainty around it, it is very palpable that it is something that's been very good for US solar and the broader energy transition. Going over to Europe, when I was on last week, we talked about SMA's strong guidance results. They're also really pushing on the utility side. And then conversely, ERG reported yesterday, and they cut their 2026 targets from 4.5 gigawatts to 4.2 gigawatts. But it's worth noting that they have grown their portfolio about 84% since 2020, and they maintained their dividend at €1 per share, which is the highest among all the peers that Joao and I look at.
Fantastic. You know, it's interesting. We're going to have to get the folks from the Solar Energy Industries Association to have a little bit of an arm wrestling match with our colleagues at Bloomberg NEF. They both agree on about 50 gigawatts of capacity adds in the US last year, but they clearly disagree on the 2023 number because the implied growth rate's a little bit higher from our good friends over at Bloomberg NEF. So it's kind of funny that we still have so much uncertainty around some of the historical data on some of these fronts. I want to ask a follow-up on the resi side. And of course, we work together, so I'm talking my own book a little bit here. But I'm curious to get your read. I mean, obviously, we've heard some challenging news from Sonova related to their debt maturities. But from a fundamentals perspective, are we going to see residential demand, whether in the US or Europe, sort of start to creep back up? I mean, partially, I'm curious if we've rebased to a lower baseline from last year because we saw the pullback. Does that give us room to return to growth this year? Or are we going to be in another sideways year here in 2025?
Yeah, I definitely see room for expansion, like you said, from a lower base. The problems at Sonova, thankfully, seem to be specific to Sonova. Some of the other solar developers, while they did cut their cash generation guidance, they didn't cut it nearly as much to the point where they removed it completely the way Sonova did. It really depends on how interest rates shake out. One good thing about the US on the resi side versus Europe is that a lot of the inventory destocking issues that we saw last year have mostly cleared. We're still waiting to see how that unfolds in Europe.
All right, thank you. Patricio, I want to swing back around to you and think a little bit more about the future of the build out across Europe, US, global. Clearly, there's a lot of emphasis on renewables. Seems like there's continued momentum there. I was kind of hinting at this idea of like gas concentration risk when we were chatting a little bit earlier. And there was an interesting note or article out from our colleagues over at Bloomberg News yesterday or 2 days ago that was was titled Top U.S. Utility Says Gas Can Meet Only a Fraction of Power Demand. And it's referencing some comments from NextEra's CEO. So I'm curious, what do you make of that remark? Does it ring true to you in the sense of, you know, what's the portfolio build out over the next 5 to 10 years going to be in your mind?
Well, yeah, that's a tough question. I mean, predicting the supply mix for let's say the whole of the power mix. Well, yeah, to your point, NextEra CEO has said that he sees incremental power demand to 2030, only about 16% of that incremental demand to 2030 being met by gas-fired power generation. And the way he supports this or tries to alert, I would say, the energy complex is that would make the U.S. sort of a one-trick pony in terms of energy. It would mean that the U.S. would become very reliant on gas, and as you know, and I think we learned, painfully in Europe, being dependent on fossil fuels is usually also, exposed to geopolitical events, and although, of course, the big difference between the U.S. and Europe is that the U.S. is a net exporter of fossil fuels, but that that may not always be the case. And in general, wholesale power prices that clear based on gas prices tend to be higher. So that means that an answer to your question is that I do still expect most of the growth in terms of capacity to come from renewables, and perhaps I think the other topic that's beginning to gain traction is new nuclear. Like, really, we will need to build some sort of either traditional reactors, which can take more than a decade, or some sort of new nuclear power generation should come online towards the end of this decade. And we're talking about small modular reactors, in which we've seen a lot of the big tech companies already plowing money into. So I do think there's still room for renewables growth, but the intermittency issue means that we need to come up with another form of baseload supply. And perhaps, yeah, there is an opportunity for higher gas demand, particularly in the US, but we will need some new nuclear. And I think that's something that's being talked about across the tech space as well.
Yeah, I want to continue on that topic, but let me just do a quick advertisement here. So, we hold these calls every Wednesday at 10 a.m. New York time. This week, next couple of weeks, actually, we're only 4 hours different from UK and Europe. So it's, 10 a.m. US, but and then once the clock's reset over there, it'll be 5 hours different versus 4 hours different right now. But most likely on April 2nd, we're going to have some of the team from Eurasia Group join us to talk deeply on the geopolitical risk that affect energy markets. So specifically, we're probably going to be hosting Herbert Crowther, who looks at specifically China, some of the solar supply chain issues. I think he's got a lot of knowledge on. And then we're going to have Greg Brew join as well. And if you've been with us for a long time, Greg's joined before, an expert on Iran in particular, but generally geopolitics around oil. So that should be a fun conversation. And, we'll continue to really talk about some of these themes that we've got here with some external guests who have some independent views on these topics. So keep an eye out for that, because I think that'll be a really fun conversation. And bring it back to today, though, I do want to noodle a little bit more on that nuclear idea you were just talking about, Patricio. So I believe there is some news out from just earlier today. I saw it in the FT at least this morning, about the idea that some of the tech companies, not all of them, seem to be aligned here, but I think it was Amazon, Google, and Meta are calling for a tripling of nuclear capacity by 2050. And I think that's all well and good to call for something like that. How the sausage gets made is a different matter. And so Patricio, I'm curious. Uh, you covered EDF before they got subsumed back into the French state. And so I think you've got some perspective on the nuclear industry. What do you make of this idea? Could we really marshal the resources, capital, and technology to do something like triple nuclear capacity? Can the private sector really deliver on a goal like that? I mean, I'm curious, just given your experience with EDF, what do you make of this idea of tripling nuclear? How hard would it be in your mind?
Very, very, very hard. I think just trying to split into a couple of buckets there. I think operational execution of a, let's say, a traditional EPR reactor, like the ones that EDF has demonstrated a long track record of cost overruns and construction delays. And we're talking about not a few years. We're talking about decades. Hinkley Point C, famously in the UK, that has blown over 4 times over budget. It's over 10 years delayed from its initial COD, commercial start date. They're still trying to find a funding partner for some part of it as well. So that ties back to the second part of the question: is private capital, geared to invest in nuclear? I think that's very very difficult, just because nuclear takes so long. So the payback periods are very, very long, very uncertain. So it is where some sort of regulated asset model, so like the way that utilities earn a remuneration on the size of the asset base, let's say for transmission or distribution of power, some sort of model in that vein could perhaps alleviate some of that, I would say, funding risk, making these assets more attractive. But you still have the operational hurdles. You still have budgets that will be blown out of the water, and perhaps delays of over 5 years. And the problem really is you need access to 24/7 cooling. You need to be close to a water source. So I mean it's not only the CapEx execution, but also it's operationally. You mentioned that EDF was nationalized. It was nationalized in 2022, mainly because of 2 reasons. So during the energy crisis, the state increased the quota that the company had to sell at discounted prices in order to shield customers. But at the same time, we had a drought in France during that time, which meant that the water levels that cooled the reactors came down. So that meant that a lot of the reactors had to be shut off temporarily, which really took EDF's balance sheet to the brink, and that's why it was nationalized. So yeah, to your question, unless there is a technological breakthrough that changes the way that we currently build nuclear, I don't, like you said in the beginning, it's something that is very nice to call for, and I hope that perhaps if we plow more investment into it, we can actually make that breakthrough. But as current things stand, that seems very ambitious.
Very interesting. Okay, so I want to give an opportunity for Alessio and Joao to weigh in on this topic. And I think we'll come to you first, Alessio. But the question in my mind is, there's been this argument for some time that gas and renewables are frenemies, so to speak. Like they compete, but they also complement each other. Does nuclear complement renewables? Do you think nuclear has the ability to eat the growth narrative for renewables in any way, at least this decade? How do you think about that topic, Alessio?
Yeah, that's a good question. I definitely think there's a lot of synergies between natural gas and renewables. a big criticism against renewable energy is the intermittency factor. Natural gas really does bridge that gap along with battery storage. As far as nuclear goes, maybe it would be a bit even more of a frenemies kind of situation. But honestly, I see a world where you can have everything. Like you're not going to have sun 100% of the time. You're not going to have wind 100% of the time. If anything, maybe nuclear can take the spot of natural gas and kind of fill that mix to be more of a greener energy mix, if you want to consider nuclear to be green.
Joao, I want you to weigh in on this topic as well. Your companies, from your note out this morning, have some pretty impressive compound annual growth rates tied to the renewable investment cycle, and they're in many ways they're growth stories. Are you worried nuclear or batteries or hydrogen? There's all kinds of energy transition plays out there. Is there something in the ether out there that maybe disrupts the renewable story in your perspective?
I mean, longer term, probably not. If some of these demand projections that we've seen in the market tied to AI and data centers do materialize, we're kind of going to need all of the power that we can, whether that's whether that's renewables, gas, or nuclear. And I think particularly gas as a role as a flexible generation source, but it's not going to eat away from renewables. I think also in Europe, if we look more at Europe, gas is very expensive, and so renewables is really the fastest to build, the cheapest, and so it can answer a lot of our problems. In the US, it's more a matter of to meet demand, you're going to need as much as possible, and renewables will continue to play a role. So I think there's probably scope longer term for everyone. It's more about each segment of power supply, kind of sorting out its own growth hurdles, which for renewables have been more in terms of the financing.
Okay, we'll let that be the last word. So thank you everyone for joining the call today. I hope we see you again next week. We're all green dots on the terminal right now, so shoot us an IB if you want to read some of the research we were talking about or explore some of the data that relates to this topic. We're happy to get you pointed in the right direction, and look forward to seeing you again next Wednesday at 10 a.m. New York. So have a great week, everyone, and thanks for your time today. Cheers.